So far, we have touched on balance of payment and monetary policy. The portfolio balanced model addressed the impact of sustained fiscal policy on exchange rate. This we have already discussed. I must take a client call, but will return shortly. In the meantime, here is some relevant literature on the Model 1 mentioned along with a couple of questions for you to consider. Question number 1. Assume an emerging market country has restrictive monetary and fiscal policy under low capital mobility conditions. Are these policies likely to lead currency appreciation or currency depreciation or have no impact? So, 1 minute. This question and question number 9 both are same. Question number 9 is referring to question number 1 and asking that the currency will appreciate, depreciate or no change. Okay? So understand one thing first of all. Emerging market or emerging country or emerging economy, these all are same thing. This point clear? Emerging economy, emerging market, emerging country, all are same thing. Emerging means developing. There are only two concepts, developing and developed, and one more, underdeveloped. Okay? So here we will talk about emerging economies, means developing economy. So they are saying that if emerging economies are there and if the government is having restrictive monetary and fiscal policy, restrictive means what? You have to spend less money. If your parent wants you to spend less money, what they will do? They will reduce your pocket money. Is it clear? So similarly, government is our parent. Government, they need to control the whole country. So what the government is doing in such condition? They will reduce the money in the pocket of the public. How? Government increasing rate of interest in the economy so that public automatically will put their money in the banking system to have more interest. Is it clear? So less money would be available in the hand of public to spend and more money will be there in the banking system and government will pull the money from the banking system. This is how they are controlling or tightening monetary policy. Is it clear? Restricting monetary policy. And fiscal policy, government will spend less money on infrastructural development. Is it clear? Yeah. And will increase tax. You have to pay more tax so that you will have less money to spend. So this is how restricting monetary policy and fiscal policy. Clear? So if we talk about emerging economies having restrictive monetary and fiscal policy will appreciate currency value. How appreciate? Because at one point of time, government is increasing interest rate in the economy, but many of the people not making investment in the banking sector. Instead of putting their money in the banking system, they are using it for improving balance of trade. They will try to export their product because they are thinking that in this country people are having less money, so people will not give the fair price of my product and I will get more price of my product if I do export. Is it clear? So if I do export, balance of trade will improve. Export will more, import will less. And ultimately this will result in appreciation of currency value. Is it clear? Getting the idea?
Yes.
Bank rate increase, but deposit does not increase. People park their money in making business, making export. So through export, what will happen ultimately? Trade balance will improve. And if trade balance improve, it means currency values automatically get improves. So currency will appreciate in case of emerging economies. If they have restrictive monetary policy, then with a low capital base, low capital mobility means low movement of capital. Clear? Then next part, question 2. Assume a developed market country has an expansive fiscal policy. Now scenario changed. Developed economy, developed market or developed country, all are same thing, and they are using expansive fiscal policy. Expansive fiscal policy means government is spending more on infrastructural development and government is taking less tax from the public so that they will have more money in their hand to spend. Okay? Under high capital mobility conditions, why is its currency most likely to depreciate in the long run under an integrated Mundell Fleming and portfolio balanced approach? So basically they are talking about DM economies. Okay? Under DM economies, if they are following relaxing fiscal policy, relaxing means expansionary, in which government will spend more on infrastructural development and government will take less tax from the public at the same time. So how the government spending is going to be matched? If the income of the government is less and expenditure of the government is more, how it is going to be met out? Of course, they have to take loan. They have to borrow money. If we want to borrow money, we go to bank. If government wants to borrow money, government goes to central bank. And what the central bank will do? Central bank will print more money, will circulate more currency in the economy to give money lending to the government, and that will ultimately depreciate currency value. That's the reason if developed economy is there, they are following expansionary fiscal policy, it means in a long run their currency value will depreciate. Clear? Then come to next question. So question number 10. Question number 10 was related with question number 2. So we have done it. Then next para. Upon her return, Wagner and McFadden review the question. McFadden notes that capital flows can have a significant impact on exchange rates and have contributed to currency crisis in both EM and DM countries. She explains that central bank like the Reserve Bank of New Zealand use forex market intervention as a tool to manage exchange rates. McFadden states, statement number 4, some studies have found that EM central banks, EM means emerging market, okay? Banks tends to be more effective in using exchange rate intervention than DM central banks, primarily because of one important factor. Stop reading. Now read question number 11. What factor is McFadden most likely referring to in statement number 4? Now see, they are talking about two things. EM countries, DM countries. Okay, emerging and developed. So basically the thing is that in emerging market, the country which is having developing stage, that country's central bank is keeping more forex reserve, more and more, as compared to DM countries' central bank. Clear? Since they are having more and more forex reserve, they are using it at the time of crisis as an insurance. Sometimes they are supplying more, sometimes they are pulling more, and they are using this as an insurance to intervene in the forex market, to increase or decrease the demand and supply of forex, to adjust the foreign exchange rates. They can do so because they have good amount of forex reserve. But when we compare EM to the DM economies, developed economies, their central bank is not keeping forex reserves at all. Their forex reserve is negligible. Okay, because they are already developed. So they can't intervene in the forex market just like EM central banks. They can't intervene, so they can't control. If they can't control, then they will fall with their head. As we saw this happen in 2007 crisis. Is it clear? The less impacted countries were EM countries and more impacted countries were DM countries. Is it clear? Getting the idea?
Yes.
Listening or not? Okay. Then come to last paragraph. Statement number 5. I mentioned that capital inflows could cause a currency crisis, leaving fund managers with significant losses in the period leading up to a currency crisis. I would predict that in affected countries, prediction number 1, foreign exchange reserves will increase. Prediction number 2, broad money growth will increase. And prediction 3, the exchange rate will be substantially higher than its mean level during tranquil periods. So out of this 3 prediction, come to question number 12. Which of McFadden's predictions in statement 5 is least likely to be corrected? Least likely to be corrected. So in my opinion, it is prediction number 1. Because if the currency crisis is there, how the forex reserve will increase? It cannot increase. If currency crisis is there in the country, forex reserve will decrease. It will not increase. Is it clear? The other 2 factors, okay, broad money growth will increase. Obviously, money supply. Broad money means money supply in the economy will increase because currency crisis is there. That's why government will relax the norms and will increase the money supply in the economy. And the third prediction is exchange rate will be substantially higher than its mean level during that crisis period. Of course, it will be higher because already you are facing currency crisis, means your currency depreciating. So that is why the exchange rate definitely will be higher than its average level. Okay? So the only prediction 1 is least likely. Clear? So this was the complete story of this case. And now move to the other case. How much time? Oh. You start reading the case. Start reading. Okay? By the time I am taking attendance. Okay? Start reading case.